Welcome to vTalkInsight, Market Drivers Daily for December 17th, 2025. AI Capex is colliding with an evolving rate-cutting cycle and a surprising burst of supply-side growth, creating a very different landscape for risk and diversification. Let's start with how the AI trend is moving from a pure growth story to a full-blown macro driver. AI is no longer just a sector narrative. It is increasingly steering the macro tape. Capital spending tied to artificial intelligence is now seen as having a bigger impact on markets than traditional macro forces through 2026, and some estimates put cumulative AI capex by major tech firms at around $8 trillion by January 1st, 2030. To justify numbers like that, these platforms need exceptional revenue growth and cash generation, which makes their earnings prints and guidance pivotal for equity and credit risk premia. Earlier this week, we talked about investors shifting into a show-me phase on AI, and the latest signals push that further. On the positive side, over 90% of upcoming AI infrastructure spending is expected to be funded from operating cash flows, and valuations for the largest platforms are viewed as broadly rational given strong earnings upgrades and robust unit economics. Examples range from Databricks generating a $5 billion revenue run rate with 55% growth, to Resolve AI beating its own recurring revenue guidance, underscoring real enterprise demand rather than pure storytelling. Adoption metrics reinforce that this is not just a buzzword cycle. Token usage for leading models has grown roughly 17 to 20 times year on year, and firms report clear productivity gains, with AI-trained workers seeing higher wages and better output. That is now spreading beyond pure tech. Walmart's push into AI, digital advertising, and marketplace models is reshaping retail competition. ServiceNow is pitching itself as a control tower orchestrating human and non-human work across enterprises, and Uber is positioning its platform to benefit from eventual robo-taxi economics. The flip side is that AI is running into hard capacity limits. AI-related power use is projected to account for about half of U.S. electricity demand growth this decade and eventually surpass other energy-intensive industries, while underinvestment in upstream gas means natural gas prices now exceed oil on an energy-equivalent basis as data centers and LNG exports compete for the same molecules. Supply chain strains are also emerging, with global smartphone shipments expected to fall by more than 2% next year as memory is diverted toward AI data centers, hitting smaller manufacturers harder than giants like Apple and Samsung. Valuation and concentration are the other pressure points. OECD and institutional allocators warn that elevated AI valuations could become a systemic risk if there is a sudden repricing, even as many see further upside for leading names with strong cash flows, such as the hyperscalers and platform companies. Market leadership is expected to remain anchored in AI and tech, but returns are increasingly concentrated in a handful of firms, while cases like Oracle's heavy reliance on a single AI customer highlight idiosyncratic risk. Traditional diversification looks less effective when a few AI names drive index outcomes, so cross-asset hedges, private market exposure, and active stock selection take on a larger role. Key watch points from here are energy infrastructure build-out, the ability of AI leaders to keep funding Capex internally, and whether competitive shifts in large language models continue to reshuffle winners without derailing the broader productivity story. The rate-cutting story is getting more complicated rather than simpler. On one hand, the White House and several Federal Reserve voices argue that strong, supply-driven growth and brisk construction activity give room to lower rates without reigniting inflation, and falling oil prices plus subdued inflation expectations support that case. On the other hand, recent cuts have coincided with a 30 basis point rise in unemployment, a 60 basis point uptick in CPI, and a 50 basis point rise in the 10-year yield, underlining that the transmission to the real economy and markets is far from linear. Market pricing implies a slow and cautious path. Futures point to two Federal Reserve cuts next year, roughly June and December, consistent with a muddle-through scenario of slow growth and easing but sticky inflation. Yet several officials argue that policy is excessively restrictive, and both leading chair candidates are seen as open to a lower neutral rate if productivity stays strong. The yield curve has steepened, with front-end yields easing on softer labor and PMI data, while long-end yields remain higher than 2 years ago despite about 175 basis points of cuts, suggesting a fatter term premium and lingering inflation or fiscal concerns, even as investors are drawn to high U.S. yields. Globally, policy divergence is becoming a dominant theme. The Bank of England is expected to deliver a dovish cut as unemployment has climbed to a 5-year high and wage growth slows. But markets still price only around 22 basis points of easing next year, leaving scope for surprises that could weigh on sterling and support gilts. The European Central Bank is drifting toward a more dovish stance if data keep weakening, while the Bank of Japan is edging toward tightening, and together that mix supports expectations for a weaker dollar as global growth improves, benefiting risk-sensitive currencies like the Australian and Canadian dollars, even though the strong carry trade performance this year leaves many uneasy about 2025. For risk assets, the rate path frames a wide range of outcomes. One bank's base case has the S&P 500 reaching 7,500 next year on the back of a single additional cut, followed by a long pause, implying modest single-digit returns driven mostly by earnings rather than policy. An alternative scenario of more aggressive easing, contingent on better inflation data, could push the index above 8,000, while the main risk case is that the Fed halts cuts sooner than expected, which would likely halt the recent broadening in leadership and push markets back toward a narrow group of winners. There are also non-trivial policy and political risks. Questions about Federal Reserve independence and concerns that executive pressure could tilt decisions toward either overly aggressive or overly cautious cuts create an additional layer of uncertainty, especially because corporate Capex is flowing into technology rather than labor, raising the possibility of jobless growth even if rates fall. From here, upcoming payrolls, unemployment, and wage data are central, as a weaker-than-expected report could bring forward the next cut to as early as January, while a steadier labor picture would reinforce the slower two-cut path that markets currently price. For multi-asset portfolios, how the yield curve behaves around those data, and how FX markets respond to diverging central bank paths will be key markers of whether easing remains a support or turns into a new source of volatility. The growth backdrop continues to look more resilient and more supply-driven than many expected. In the U.S., productivity, capital stock, and labor trends point to real GDP growth that could exceed 4% next year, with more conservative forecasts in the 3 to 3.5% range still well above consensus. And productivity itself is expected to run above 2%. Supporting real wage gains without ringing alarm bells at the Fed. Importantly, recent strong GDP prints have relied more on productivity than on job creation, indicating that the economy is doing more with a relatively stable workforce. Investment patterns reinforce that picture. U.S. capital spending jumped more than 10% after a major bill passed in July, and a wave of factory construction, particularly in sectors tied to national security and supply chain rewiring, is expected to reverse recent declines in manufacturing jobs next year. Alternative labor indicators already show private employers adding over 16,000 jobs per week in late November, and 8 out of 12 metrics ahead of the payroll's release point to a slightly better employment outlook than the headline consensus suggests. Outside the U.S., there are multiple pockets of acceleration. Emerging markets earnings growth is projected around 15 to 16%, with less stretched valuations than U.S. equities. Crude oil is forecast in the $50 to $55 range next year, which could act as a growth dividend for importers, and Chinese stimulus is expected to lean on investment, supporting activity even as consumption and trade tensions remain headwinds. In Europe, French manufacturing PMI has moved back above 50, and UK private sector PMIs show all major industries in expansion, while targeted energy investments in places like Iraq, a 40% jump in global M&A volumes, and record ETF launches and inflows all signal a broader pickup in risk-taking and real activity. For markets, this increasingly looks like an earnings-led rather than policy-led cycle. Corporate profit growth, particularly double-digit gains, is expected to be the main driver of U.S. equity strength, with names like Amazon Web Services and ServiceNow highlighting sustained 20%+ organic growth potential, and global equities are seen gaining into early 2026 on the back of easy policy, fiscal stimulus, and ongoing AI Capex. Consensus expects U.S. equities to deliver around 10 to 12% upside in 2026, while emerging markets offer strong earnings growth without record-high multiples. But elevated valuations everywhere raise the cost of any disappointment. Yet the expansion still has clear fragilities. The U.S. economy is leaning heavily on consumer spending fueled by wealth effects and on tech and AI-related investment, creating a two-legged structure that could wobble if either markets or Capex slow, and higher long-end yields have already offset some easing in financial conditions and tempered next year's outlook. Underinvestment in energy, the risk of an AI valuation reset, and a cruise sector facing near-term oversupply all illustrate how capacity constraints and misaligned incentives can bite if growth overshoots. Key watch points now are whether productivity and GDP data actually deliver in the 3 to 4% band, how quickly new factories translate into hiring, and whether growth broadens beyond AI-centric and high-income segments to underpin a more durable global cycle. To wrap up, AI has become a true macro force, with massive but increasingly scrutinized Capex, rising energy and concentration risks, and a clear shift toward fundamentals-driven returns. The easing cycle is advancing, yet the mix of slower front-end cuts, stubborn long-end yields, and global policy divergence keeps the rate and FX outlook very path-dependent. At the same time, supply-side investment and productivity are supporting an above-consensus growth narrative, but on foundations that remain narrow and sensitive to policy, energy, and valuation shocks. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.